I am saying the melt up starts imminently. It's now. It's
Oh,
not
okay,
three to
that's
six
good, good,
months
good
from now.
clarification.
The,
So now,
the,
okay.
the top is 3 to 6 months from now. So I think this thing, you can go, I'm calling for, as you know, when you do those numbers, I'm calling for, 40 to 50% upside, certainly from the lows of a couple days ago, in less than 6 months. I mean, that's absurd. I'm fully aware that I'm making a crazy call.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Few experts I interview generate as much controversy as today's guest. He's a contrarian by nature, and so is most comfortable when his forecasts differ extremely from the consensus view. And despite today's grim macro outlook of spiking inflation, rising cost of debt, a struggling consumer, inverted yield curves predicting recession, he is doubling down on his forecast that the S&P will leap higher by 40 to 50% over the coming 3 to 6 months. And if that's not a bold enough prediction for you, he's then calling for the markets to fall soon afterwards by up to 80% as the biggest financial crisis in US history takes place. Now, can the prediction of such massive moves be credible? To find out, we asked the man himself, David Hunter, for all of the details on these forecasts. And David doesn't disappoint. Agree with him or not, there's a rationale underlying his conviction. To hear it, let's get straight to the interview. David, thank you so much for joining us today. It's been a while. I'm really looking forward to getting back into this with you.
Hi, Adam. How are you?
I'm great. I'm great. Well, look, it has been a pretty busy couple of months in the markets, a very roller coaster ride in the market since you and I last talked back in January. I really want to follow up with you on your forecast that we discussed back then. But before we dig into that, I just want to start at the very high level like we do every time we talk and ask you my standard opening question. What's your current assessment of today's global economy and financial markets?
Yeah, sure. My forecast hasn't changed all that much in spite of what we've been through. I am still looking for a melt up over the next 3 to 6 months, and I just describe a melt up as something more than just a rally. I think the term gets used a lot, misused a lot, but I really think this is a once in a generation type final parabolic rally into a top. And in spite of what's going on with interest rates, and in spite of what's going on in Ukraine, and really because of all the bearishnesses in the market, I think we're on the verge of something quite unusual. And I'm still calling for 6,000 on the S&P, 20,000 on the Nasdaq, 45,000 on the Dow, 3,000 on the Russell, and I'm still looking for rates to peak out here in spite of the Fed talking about a long runway of rate hikes. So I think we are at major inflection points for both the bond market and the stock market here, as well as the metals. So I think the metals are they've been performing somewhat better the last few months, and I think they're really on the verge of something quite spectacular.
All right, good. So in terms of the specifics of the forecast, sounds like little has changed since we last talked, although it looks like you might have even raised some of your projections. I want to get into the details about all of that. Additional price targets for certain sectors, what you think is going to do real well. I am presuming after this melt up, you are still believing that there's going to be a big meltdown. Last time we talked, you were kind of pegging the order of magnitude, perhaps as high as 80%. Do you still believe there will be a meltdown after the melt up?
Yeah, very much so. I think this is truly the end of a 40-year secular bull market. And I have said many times, I think the high water mark we reached this year is not likely to be seen again for decades, and that's in the market. So I do think we could see as much as an 80% decline in the market following that. I'm calling for a global deflationary bust that probably starts late this year and carries through all of next year.
Okay. All right. I want to get into the details of that as well. And just to put a coda on this, in our past times we've also talked about kind of what comes after the bust. And I'd like to talk about that too. But let's reserve that because we got plenty to dig into in the short term. All right. So David, I gotta be transparent to, the discussion that's been raging on Twitter over the past bunch of months. I know that you've been taking slings and arrows from the critics on there because the timing that you initially thought was going to this might happen on, and I should be very fair to you. You are not making market calls, right? You're not saying, hey, on February 1st, this is going to happen. Your confidence is sort of in the trend, and it's going to take whatever time it takes to play out. So you're making more of a trend forecast, and please correct me if that's wrong. But there have been some people who, understandably have said, hey, David, you've been talking about this Meltup for a long time. It seems to keep shifting. I want to give you the opportunity to explain that here. And in your question, if you can address, did the war in Ukraine, was that something that impacted the timing of all this, or is it immaterial? I'll let you go here.
Sure. Yeah, but I will correct probably what you used as a term. It's really not, I'm not following a trend. I'm really making a market call, but I consider it a cycle call. In other words, I'm not worried about whether it happens. If I get within a few months, or even several months of the original call, it's a 40-year top. I mean, I don't try to pinpoint is it going to happen in June or July or September. I get myself in trouble because I do give, I'll say, well, coming into this year, I said, well, we could see the top by the end of the second quarter. And then, of course, now I'm stretching it out and saying 3 to 6 months, so it carries you through the third quarter. And that drives people crazy. They go, you just keep moving it. That's like anybody can be right if you just keep moving the target date. And I go, no, it's not really about a date. It's the end of the cycle. And, these are big cycles that go on for more than a decade. I'm not too concerned about trying to call it down to the week or month or even quarter. So I do, when I put out a day, as I tell people, it's kind of this, if everything fell into place, this is the earliest I think you'll see it. And then it just stretches out. Cycles tend to stretch out. Obviously, in this case, Ukraine was, had an impact and did probably stretch out the cycle a bit. And so that has some impact. But I'm guilty. I'm a longtime value manager. My first half of my career was as a institutional money manager, longtime value manager, and I would say my MO is that I'm always going to be early. And I'm a contrarian, so I'm not really trying to. That's why I take issue with the term trend, because most people are trend followers. I'm really quite the opposite. I'm picking things at inflection points and then trying to figure out when. So I don't know if that explains it well, but it's certainly, I think that you're right. There are a lot of people on Twitter that they want precise timing, and I go, that's not me. I'm giving you a cycle call, not a trading call. And I will say, Twitter is filled up with traders. I would say the vast majority of people, even those that follow me, are trader types, whether they know it or not, and they're typically, so they're more likely to be trend following traders looking at technicals. I'm a contrarian, kind of does things backwards. I look at charts, I look at technicals, but I also am very much trying to spot inflection points, which is the opposite of a trend.
All right, great clarity. And yes, as a contrarian by definition, you're kind of on the lonely side of the boat on, on any one of these things. You're probably nervous if the crowd is with you, right?
Right.
All right. So, and by trend, just to clarify, to me, I feel like you're the guy that says this is the shape of the curve I think things are going to follow, and then it's just a matter of trying to sort of peg when the timing of the curve is actually going to happen. And you're right, because we've talked before. You have said this is the end of a 40-year bull market cycle, and when you have a period that long, it's pretty hard to peg, its terminus to an exact date or probably even exact month or maybe even an exact quarter. So there's some fuzziness here. So I totally get what you're saying.
Yeah, as I tell people on Twitter, nobody should be buying options off of my calls. They're just not that precise.
Okay, great caveat. All right, so I'm going to put my hat on again for people that have been following you for a while, David. The Meltup still at this point feels like a really contrarian call, even more so than when you and I were talking, earlier in the year, because the markets have cooled off a little bit, not much, but there's so many more kind of recessionary concerns going on now. Economic growth is slowing, inflation's rising, the cost of living. There's lots and lots of reasons that we're beginning to see, mortgage rates go up, and that creates a negative wealth effect for households. So, when you and I have talked in the past, if I've understood you right, you've said every bull market ends in sort of a euphoric blow off top, right? There's sort of like a manic, final thrust to it. And I think people are saying, I'm finding it hard to find the mania here that's going to drive that Meltup euphoria. What do you say to people who raise that concern?
Yeah, I would not say, first of all, I would not say that every bull market ends in a euphoric parabolic. They do end with more bulls, with mostly bullish. But I think this is going to be very unusual in terms of the degree to which we see a parabolic. So, and I think it's because it has been an extra long cycle. 40 years for a bull market cycle is big. We started this thing in 1982 with single digit PE multiples with interest rates at 15%. It's ending with rates obviously moving up right now, but got down to close to zero. PE multiples got up, the market multiple got up to mid 20s. So it's a huge 40-year period. And I think because of that, and because of other things such as the pandemic, we've got, and the amount of money that's been created, we've got a condition that's very unusual historically. I really don't think we've seen anything like this since 1929. So we are coming to the end of something quite unusual. In prefacing everything, I forgot what your question was.
Well, it's sort of what's going to provide the trigger for the parabolic end here, because going from wherever we are today, 4,400 or so in the S&P to 6,000 in the next 3 to 6 months, that's a big jump, and there's not a lot of positivity right now, especially with interest rates rising and whatnot, inflation running out of control, all that stuff. So what is going to cause that big jump in the markets in such a short period of time?
Yeah, I don't, by the way, because I repeat these forecasts for a long time, they look like I may kind of just pull them out of the air and that I take them rather cavalierly. I don't. I mean, I am as skeptical as anybody can be about what's coming. But keep in mind, a contrarian is driven very much by sentiment. I'm gonna, think about what we just saw on the AAII poll. That we had more bears there than we've seen through bear markets going way back, even to 2008-9. And so if you have that many bears after a doubling in the equity markets in the last 2 years, that's a very telling statement. We have discounted an awful lot in this market. People act like whatever is in the market today is, equilibrium, and so then you look at the news today and discount from there. We've discounted an awful lot of the bad news. We've been hearing about bad news since last summer. And by the way, interest rates have gone, the 2 years gone from 0.25% last September to 260. The 5 years gone from 0.75% up to almost 290. So I mean, we've had a tremendous amount of tightening, and people are acting like the tightening cycle is just beginning. What I keep saying is the tightening cycle is coming to an end. Imagine what doubling the mortgage rate from 2.5 to 5.25 or 5.5 is going to do to affordability for one thing, but just activity in the housing market. It's you have to give it time. It doesn't all happen immediately, but I think it's slowing the housing market. We're seeing consumer sentiment. The Michigan consumer sentiment is down at levels that predict recessions. So there's a lot of things already in there, and inflation is a lagging situation. It doesn't typically, the economy gets hit by policy faster than inflation does. Inflation lags to the tightening. So my guess is we're not that far away. I think the economy's maybe doesn't have to, but I think there's a real chance that we could see a negative GDP print in the second quarter. That's going to get the Fed's attention. I think commodity prices, which are the biggest thing driving inflation, are up on stilts. And I'm not going to pick which month they're going to roll over, but I think we've seen the vast majority of the inflation momentum already. So, again, the street is kind of backward looking and pushes the trend forward from that. I'm telling you, we're not that far away from a big trend shift, a big shift in sentiment towards, whoa, the Fed's gone too far. So right now, it's like everybody's playing leapfrog as to how high the 10-year is going to go, right? How high yields are going to go. I think we're peaking yields right now. And so, yes, it seems crazy to say that when you've got, 7 hikes predicted for this year and several more for next year. The Fed has, the Fed's MO is they always are getting on board and ready to really tighten at the time when they've already gone too far. And I think this time it's even harder than normal because of what's happened with supply chain, what's happened in Ukraine. So, Powell fought it, I think, for a while and said, yeah, inflation's transitory. We're just not going to fall for that trap. But then what happened in the last several months where inflation just ramped up, he couldn't ignore it anymore. And I think he jumped on board and said, we've got to get serious about this. Obviously he did. But I think he did it late in the game. And I think he's going to, be forced, just like he did in 2018, to do an about face.
Okay, so let me summarize that a little bit. And you tell me if I'm hearing you right. But it sounds like you're saying, like any good contrarian should, is saying, look, people are way more bearish than they were a year ago. It's kind of been this steady drumbeat of bad news. I think you're maybe making the argument here that the reasons to be bearish are getting close to being played out, and the market may be, I'm going to use the word oversold, at least sort of in a near to midterm level. And you expect you're noting those conditions, and you're saying that's just ripe for some kind of relief rally if given the right trigger, and that trigger could be a Fed pivot. It could be, inflation coming down faster than people think. But basically you see some sort of trigger out there that's going to make the market realize that, like, oh, it's not nearly as bad as we were all thinking. Time to get back into the pool. Is that more or less correct?
That's more or less correct. And I think you'll have things like potentially oil prices coming down, followed by gasoline prices. So the Fed will have some breathing room. Not that all commodities are going to turn down at the same time, but if gasoline turns down, that's a huge one for the Fed, because
oil and gas are
they're, So I think there's a real possibility, particularly looking at the charts, that oil has seen its peak and is starting to roll over. I would not be surprised, and I've been wrong on oil certainly since Ukraine, but I would not be surprised if we saw kind of a one-off panic peak, and that it's beginning to decline from there, and that we might be back into the 80s within the next few months, and maybe even down into the 60s within the next 6 months. So, I think oil and, gasoline, particularly for consumers, could be that thing that kind of sticks out for, the street and for the Fed in terms of saying, wow, that takes some of the pressure off inflation. And then I think some of the other things, food prices, grains, some of the other commodities, metals will follow at some point. So, yeah, I think inflation is probably at least at this point at peak momentum. It may not be at total peak yet, but we're getting close, I think. And more importantly is if I'm right that the economy is accelerating faster than people realize, when something gets printed there that surprises, I think the Fed's going to sit up and take notice. They're not totally blind to the fact that sometimes they go too far. I think Powell's very aware that, he has to be more forward looking than backward looking.
Yeah. Hey, let me just jump in here for 1 sec. So a lot of the recent experts I've been talking to on this channel have basically said, and I think this is what you're saying, which is, look, the Fed is going to hike until something breaks, right? And some of these people think, the Fed's not going to be able to hike very high before something breaks. And I just heard you say the Fed got on board inflation late in the game, but it's now has to take it seriously. You're thinking that the GDP print in Q2 might be negative, and if so, that's where the Fed might be like, whoa, okay, well, we went a little bit too far. So I know we're talking about a relatively short period, the next 3 to 6 months before this melt up happens that you're predicting. Do you see that it could get worse first, right? When that break happens, and then the pivot comes, and then the rally?
Anything's possible, but I want to clarify. I am saying the melt up starts imminently. It's now. It's not.
Okay, that's good clarification. So now, okay.
The top is 3 to 6 months from now. So I think this thing, you can go, I'm calling for, as you know, when you do those numbers, I'm calling for, 40 to 50% upside, certainly from the lows of a couple of days ago, in less than 6 months. I mean, that's absurd. I'm fully aware that I'm making a crazy call. This is, like I said, this is not like any other rally. This is something very unusual. And I do think that, certainly the retail public doesn't understand this. Markets often work on rate of change, second derivative. So, I get beat up on Twitter by people who think the news they see today is what the market's going to move on. And it's not. It's obviously it's a discounting mechanism that looks out many months. And it's also, there's, professional money managers are looking at second derivatives of things. So a lot of stuff may not make sense, but the changes start happening before you see them in the numbers.
All right, great. And they have that old saying, a bull market climbs a wall of worry. And I guess since we're at the end of this 40-year bull market cycle, there's a potentially a lot of worry that you've even just mentioned that bull could climb from here, where it could be inflation that's still peaking, even though the rate of growth might be coming down. You mentioned the potentially a negative GDP print. So your melt up is happening in the face of all of that, should that come to pass.
Yeah, and I as a contrarian, I'm driven very much by sentiment. And all the sentiment indicators are showing that that investors are extremely bearish. And that is that wall of worry that provides the fuel. Bearish sentiment means people have already acted on that bearishness. So there's a lot of money that's, people have repositioned themselves. So they're either in cash or they're in defensive places. And that means as the sentiment changes, as the tape moves up, the sentiment will change with the tape, with the momentum in the market. As that moves up, people will come off the sidelines and say, oh, I've got to put money back to work because this isn't going down, it's going up. People are most bullish at the top and most bearish at the bottom, and we couldn't be more bearish than we are right now. And I'll just talk technically quickly. The reason I'm saying we turned as of the last couple of days is, a few weeks ago, probably in latter part of March, when we were approaching 4,600 on the S&P, I said, we're probably going to have one more pullback before we go. And as you know, we had a 10% rally out of the lows in early March, and people were saying, maybe this is takeoff time. And just like back in December when I fought it, I said, no, this isn't the melt up. You're probably going to have one more pullback.
Yeah,
the reason I said that it looked like a setup of an inverted head and shoulder. We came down to particularly on the NASDAQ, right into the right shoulder and took off yesterday. So I think we finished our pullback, and the pullback is within the whole context of the last 4 months of correction. We started the correction beginning of January. So I think we're just beginning the takeoff point, the emergence from the correction. We're not out of the correction yet, but we're not very far from, moving up to new highs here. And I think that is the start of the melt up that could happen in 3 months or could happen in 6 months. But it's, I think it's going to be a very rapid rally. And it's going to be broad. Unlike most people out there today, most pundits talking about, you can have a narrow rally, a bear market rally. I'm saying this is the final bull leg of a 40-year secular bull, and it will be broad. It will be growth stocks. It will be value stocks. It will be small cap. It will be large cap. I think one of the areas that will lag will be energy, which is ironic. Most people think energy is where you want to be right now, but I think most other things are going to be in play.
All right, great. Well, look, thank you for letting me kind of beat on your Meltup pinata here since we last talked. Let's actually lean into exactly what you think is going to happen during the Meltup, and then I want to get obviously into the meltdown after that. As you were talking, I just set myself a note here, David. We'll bring you back on this channel when the S&P hits 5,500 or by July, whichever comes first, and then we'll give you a chance to give us an audible on where you think things are there. All right, so you mentioned that this is going to be almost an everything melt up. Real quick, you mentioned NASDAQ to 20,000, S&P to 6,000. I'm looking at some of the notes here. I think it was the Dow to 45,000. You said, look, I'm looking at some of your past tweaks here. Likely to be the biggest, steepest rally in the post-World War II era. Broad rally in both growth and value, large and small caps, participating commodities, industrials, tech, including FANG, semis, and ARC, autos, airlines, steel, financials, and miners will all play. So it really does seem like it's a pretty broad base. Is there any particular sector that you think will perform particularly well, that you think, people would be wise to consider? And are there others besides energy that you think may kind of sit it out?
Yeah, I think the ones I listed there are probably the ones I think are all going to participate pretty strongly. So, I think semis, which have been through a pretty rough correction here recently. I'm calling for SMH to go to 400.
Sorry, David, just for the folks that are watching who don't know what SMH is, can you clarify what that is?
Sure. Yeah. SMH is the ETF of semiconductors. So it's a pretty representative basket of stocks, of semiconductor stocks. Kind of gives you the representative move that you would have across the board in semiconductor stocks. So I think, I'm trying to think where it got down to here recently, but maybe 230, and I'm calling for 400. So that'd be quite a run.
Yeah, almost a doubling. Yeah.
Yeah. I think semis will be one. It's like I said, it's kind of interesting because I think growth stocks will play. Netflix notwithstanding, Netflix got beat up pretty badly today. So, but the FANGs in general, I think outside of Netflix, I think will probably do pretty well into the top. Facebook, obviously, and I can't talk individual stocks, but I know Facebook's been beat up. So I'm not saying they will all go to new highs by any means, but I think they will be equal to the NASDAQ or higher in terms of their percentage gains from here. And I'd say even the small cap, the ARC, I don't follow it, so I'm not making a recommendation on it. I can't anyway. But just as a representative of small cap tech, I'd say, it certainly can move back to its 200-day moving average, which would be, I think, a 60 or 70% move, maybe more. So again, it's ironic that I think we can have a move in commodities and industrials, very cyclical companies, stocks, and at the same time have a big move in growth stocks. And the reason we can do both is because I think you're still going to have momentum in the commodities and in the producers. Their cash flows are big right now because of the moves in the commodity prices. So the next couple quarters, they're going to still be printing pretty good earnings. And so there's momentum at the back of the winners of late, the commodities. At the same time, that if I'm right, that interest rates are going to be rolling over, people are going to be moving back into those growth stocks that got beat up so bad with this interest rate move. So you're going to have both playing. And again, part of it comes from people having to shift from being so bearish to all of a sudden realizing that, they're missing something. And then all of a sudden, what really drives the final move is FOMO.
Is the FOMO, yeah.
Yeah, it's my goodness. People don't realize this, but really sentiment is a momentum process. People follow the tape. They get bearish as the tape gets worse, and they get more bullish as the tape gets better. And that's the opposite of what we do when we go out and buy a stove or refrigerator. We're looking for something on sale. But with sentiment, people are getting more bullish as things move higher.
Yeah, you're reminding me that I need to get another behavioral economist back on this program soon, because it's such both a fascinating, but I think really key element to investing strategy. Because if you're not familiar with behavioral economics, folks, it's basically the study that we think people would make incredibly rational decisions around money and stocks and investing because it's so quantifiable. And in fact, we tend to make incredibly irrational decisions because we're human animals, and sometimes our evolutionary wiring works against us here. And David gave a great example where people tend to pile into the market when prices are going up, as things are getting more and more richly valued, where in a lot of cases we should be piling in when things are going down because we're getting them at deeper and deeper discounts. But that's a story for another day. Point of clarification, David. So you mentioned you think the commodities, you said commodities will do well, but I think you really mean the commodity producers will do well. If I heard you correctly,
right.
Some of the commodities may actually be coming down in price, but they're still right at very elevated levels, meaning the commodity producers are still going to be very profitable. But I want to clarify that just in case somebody goes into a oil or ETF or a wheat ETF or whatnot. You might think that those prices may actually be coming down over this period while the
Absolutely.
Producer prices will be going up, correct?
Yeah, that's a good point. I kind of shortcut things and say commodities because I'm talking about stocks, but yes, it's commodity producers because, as you say, the prices are still going to be elevated even if they're rolling over. And so they have momentum in their earnings, and they will for the balance of this year, I'm sure. So I think for the next couple quarters, for sure, the earnings there are going to still be up to expectations, if not beyond.
Okay. All right. So last question on the melt up, and then we're going to get to the meltdown. So I know that you remain pretty bullish right now on how the precious metals and the precious mining companies are going to fare over the this melt up period here. And let me just pull this tweet of yours. This is from April 14th. So just about a week ago. Gold and silver have begun their bull moves and are poised for big upside. I've raised my pre-bust gold target to 3,000, up from 2,500. My silver target remains at 50. Miners also look ready for a big run. GDX to $65, GDXJ 100, SIL 75, SILJ 35. Been a long wait, but now look ready to run. So that was just a week ago. So I assume you're still there in terms of those price targets. Can you just sort of give the rationale why you think those are going to perform so well?
Sure. We've come through, just going back to the March 2020 bottoms. Gold and silver had great runs into August of that year, very fast runs where they, gold went from 1460, I think, to 2100 in 4 or 5 months, and silver, I can't remember where it went, but it was a big move. And then they went sideways to down for 18 months. I thought they'd have a consolidation for 3 to 6 months and then go. They went, sideways to down for 18 months. and investors got really discouraged and gave up on them. I think you have an awful lot of people that said, crypto's taken over, gold and silver are dead, etc. They, at the beginning of this year, began acting better, actually late last year, and they have outperformed certainly equities this year. But if you step back and look at long-term charts, you can call it a cup and handle, you can call it a huge wedge, but they are really positioned to break out. I think gold, once it gets above its all-time highs of 2,100, it's pretty clear sailing. That's why I raised my target. I think it's going to be an easy shot to 2,500, and I think sometime this year you could see it get up as high as 3,000. Silver, once you get above 30, it's not new highs, but it's pretty clear sailing from there, I think. And the miners have, I mean, this in my opinion is the cheapest, most attractive asset category of any out there. It's been, really has lagged everything else, and I think both technically and fundamentally is really poised for much higher here.
Okay, all right. So I'm proving myself a big liar here. One last question here about this Meltup. So imagine for a moment that Jerome Powell surprises you and that he is more committed to fighting inflation. Let's say inflation doesn't come down quite as quickly as you think, and he keeps hiking. What would that do to your current Meltup prediction here? Nothing, or would it have an impact on it?
Yeah, I should step back and say I actually, and I've said this several times in the last few months, it's really I'm not here to try to predict what Jerome Powell's going to do or what the Fed's going to do at each meeting. I'm looking at the bond market. The bond market will lead, the Fed will follow. So in my opinion, the bond market is showing all signs, technically and fundamentally, that it's done, that the damage has been done, that the tightening has happened. As I said, we're at inverted yield curves. We've had these huge rises, and it's really rate of change in rates that is more of a tightening factor than just the actual level. So we've had big jumps in rates. The bond vigilantes have done it. So, I actually think we'll see a 50 basis point hike in May, and we might see one in June. That doesn't affect my forecast. I'm not betting on those not happening, but I am betting that what I see in the bond market is signs of a top in rates and a bottom in bonds. I am making the prediction that the 10-year is going to go from, its current 295 and now back down under 290, all the way to zero next year. So I think we are seeing the cycle highs in rates. I know that's not what you're asking me, but I think we're looking at the cycle high in rates, and at the, in the global bust next year that we're going to talk about, I think you're going to see 0, 10-year, or maybe even negative rates on the 10-year. The 30-year could go from 3% down to a quarter. So everybody's looking backwards at this rate rise, and I'm looking forwards and saying, I think we're at the peak in rates, and there's a huge decline coming, not a small one, a huge one coming. Now, most of that is going to happen later as the economy really turns down. So I'm not saying you're going to see the big momentum in rates down. You might get back to 2.5 or 240, or even lower in this summer. But the big move is going to be later on when it's clear that the whole global economy is free falling. But if I'm wrong about the Fed and the Fed does do 7 hikes this year, I'm probably wrong about my call. I just don't think we're going to see the Fed have that much time, that much room to hike. They might hike for May and June. I think we're going to see either 2 and done or 3 and done is my guess.
Okay.
So we've already had 1. May would be 2 and June would be 3.
Got it. And if I hear you right, it sounds like you're watching the Fed less than you're watching just bond yields. And so I guess my question, in wrapping this up, but this is kind of a key question because I think it could be a key question because it may impact your forecast. which is if bond rates keep rising, if bond yields keep rising longer than you expect, would that then cause you to have to reevaluate?
Certainly, I think I'd have to say yes. And I'm not talking about 10 or 20 basis points. That's not going to affect me. But if I'm wrong by a lot on rates, if the 10-year goes to 3.25, 3.5, sure, this is not happening. This scenario is probably not happening.
Okay, so that'll be a key metric you'll be watching, and it'll be a key metric the rest of us will be watching too. All right, so now we've talked about this violent melt-up. As you're forecasting likely over the next 3 to 6 months, again, we'll have you back on in the summertime to tell us how well it's been going or not. We're now at the peak of that, so let's fast forward. What happens from then, and what triggers the reversal?
Okay, this gets a little tricky.
Our interview with David will continue over in part 2, which will be released tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure also to hit the like button while you're down there. Last, if this massively turbulent outlook David detailed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no-strings-attached portfolio review by a financial advisor who can help manage your portfolio, keeping in mind the trends and risks David mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our video interview with David Hunter.